Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at WeRide.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Usually when we talk about the future of transportation, I can practically hear eyes rolling. It feels like we've been promised self-driving cars, robotaxis for, a solid decade now.
Oh, easily. It's the ultimate boy who cried wolf technology. Every single year, it's 5 years away. I remember seeing concept videos back in 2015 that looked like straight up sci-fi.
Right.
And yet here I am, still stuck in traffic, manually driving myself to the grocery store. It's become a bit of a running joke in the tech industry, hasn't it?
It has. It's been stuck in that science experiment phase. Cool to watch on YouTube, but not something you actually see in your neighborhood. But today, we're looking at a company that might just be breaking that curse. We are talking about WeRide. And the reason it's on our radar right now isn't some cool new demo video. It's because the narrative is finally shifting from cool science project to an actual boring business.
Okay, actual business is a bold claim for the autonomous vehicle space. I'm looking at the chart here, and boring is not the word I would use. This has been a wild ride.
It has.
The 52-week range is anywhere from around $6 all the way up to $44. That is some serious, stomach-churning volatility.
It is. It's classic early-stage tech behavior, right?
Yeah.
Investors are trying to figure out if this is a zero or a hero. But here's the hook. The stock recently surged nearly 15%. And that's coming off the back of some very specific, very tangible news. It's not just hype anymore. We have major institutional validation.
When you say institutional validation, are we talking about high-frequency traders or someone who actually has, a thesis?
The thesis. The headline grabber here is Cathie Wood. ARK Invest officially purchased WeRide stock on January 20, 2026.
Oh, wow. Okay. Look, love her or hate her, when ARK buys, people pay attention. It usually signals they believe the tech is ready for prime time.
Exactly. And they didn't just buy it in isolation. They bought it alongside BYD and Broadcom. That tells you they aren't just betting on a single lottery ticket. They're betting on a verified ecosystem, the chips, the manufacturing, and the software.
Okay.
But before we get too caught up in the stock price, we need to look at what WeRide is actually doing on the ground. Because frankly, their footprint is shocking compared to what most people in the U.S. are used to.
Right. Usually when we talk AVs, we think of Waymo driving around San Francisco or maybe Phoenix. Is WeRide just doing the same thing, circling a few blocks in a test zone?
They're doing that, but on a scale that's kind of hard to wrap your head around. As of mid-January 2026, specifically January 12th, they have over 1,000 robotaxis deployed globally.
Wait, hold on. 1,000?
1,000.
That is significantly more than I expected. I figured you were going to say maybe 50 or 100 test units. 1,000 feels like a legitimate fleet.
It is. And they aren't just on a closed test track avoiding traffic cones. We are talking about meaningful deployment in real traffic. This is the core of the thesis today. WeRide is transitioning from R&D, spending money to see if the physics work, to commercial revenue. They are starting to turn the machine on.
So let's unpack this global aspect. You mentioned they aren't just in one city. Where exactly are they operating? Because usually getting a license for a robotaxi is a nightmare, right? You need permission for every single city block, practically.
That is exactly right. And that leads us to their biggest competitive moat.
Okay.
Regulatory dominance. WeRide hold autonomous driving permits in 8 different markets. 8. China, the UAE, Singapore, France, Saudi Arabia, Belgium, Switzerland, and the U.S.
Okay, that is a massive spread. But let me play devil's advocate here. Is this just a trophy case? Does having a permit in Belgium actually mean anything, or is it just a press release? Why does this matter compared to the U.S. competitors we know?
It matters because of the path of least resistance. Think about Waymo or Cruise. They are incredible companies technologically, but they are largely confined to the domestic U.S. market.
Right.
They have to fight tooth and nail for every expansion into a new U.S. city, dealing with local town halls, protests, and very strict federal oversight. WeRide has effectively diversified their regulatory risk.
So if regulations get tight in the U.S., they don't just shut down. They have 7 other playgrounds.
Precisely. It's a survival mechanism. But it's not just about having the license. It's about where they are choosing to double down. This is where the story gets really distinct from the Silicon Valley narrative. They are executing a very aggressive Gulf strategy.
The Gulf strategy. You mean the UAE and Saudi Arabia?
Yes.
Why? I know there's capital there, but is there a market for robotaxis?
Yeah.
Why would they prioritize the desert over, say, New York or Leiden?
Think about the infrastructure. Cities like New York or London are hundreds of years old. The streets are chaotic, narrow, unpredictable. Now look at Abu Dhabi or the new developments in Saudi Arabia. They're modern, wide, grid-based, maintained perfectly.
Hmm.
But more importantly, these nations have massive Vision 2030 goals.
Right, moving the economy away from oil.
Exactly. They want to build smart cities from the ground up. Autonomous vehicles aren't just a cool add-on for them. They are a central pillar of their infrastructure planning. Unlike in the West, where an AV company might face bureaucratic gridlock, these governments are actively partnering with WeRide. They are rolling out the red carpet.
So instead of fighting the city council is basically writing them a check.
Correct. And here's the metric that should make your ears perk up. The Abu Dhabi fleet is nearing single-vehicle profitability.
Okay, let's stop there. Single vehicle profitability. I hear this term thrown around a lot. What does that actually mean in plain English for this company?
It means that the revenue generated by one single robotaxi picking up passengers, dropping them off, is about to exceed the cost of operating that specific car. This includes electricity, maintenance, remote monitoring, everything.
That's the holy grail, isn't it? Because right now, for most companies, every single ride is subsidized by VC money.
Exactly. Before this point, every new car you add to the fleet just accelerates your losses. You're digging a deeper hole. But once you cross that line of single vehicle profitability, every new car adds to your bottom line.
Got it.
Once they cross that line in Abu Dhabi, scaling becomes a mathematical exercise, not a gambling one. They are talking about scaling to tens of thousands of robotaxis by 2030.
That is a massive shift. It changes the whole equation from how long can we survive to how fast can we grow. But I want to pivot to the user side. You have the cars, you have the friendly government, but you still need riders.
Right.
And I'm imagining downloading a new app, putting my credit card. It's friction. People are lazy. I barely want to open the apps I already have.
You are absolutely right. Friction kills adoption. And this is where WeRide has another massive advantage, specifically in their home market of China. It's a piece of business model innovation that we just don't see in the West. It's called the Super App Integration.
I think I know where this is going. Are we talking about WeChat?
We are. WeRide launched the WeRide Go mini program directly inside Tencent's WeChat.
For listeners who haven't spent time in China, we really need to explain what WeChat is, because calling it a messaging app is like calling a smartphone a pocket calculator.
Right. In the West, we have separate apps for everything. Uber for rides, WhatsApp for chat, Apple Pay for money. In China, WeChat is all those combined. It's the operating system of daily life. You don't just chat on it. You pay bills, you order food, you book appointments.
So WeRide isn't asking you to download their app?
No. Imagine if Uber wasn't a separate app, but was being directly into your text messages. And your credit card was already linked, and you were already in that app chatting with your friends about dinner. You just tap a button, and the car comes.
Yeah. That is a game changer for customer acquisition costs.
It lowers the barrier to entry to almost zero. Think about how much Uber or Lyft spends on marketing just to get you to install the app. It's millions. WeRide bypasses that entirely in Guangzhou and Beijing. They're fishing where the fish are already jumping into the boat.
That is smart. It leverages an existing ecosystem instead of trying to build one from scratch. So they have the licenses, the Gulf strategy, the WeChat integration. That sounds pretty solid.
Yeah,
and there's always a big but.
Yeah.
How are the numbers looking? Because this has to be incredibly expensive.
It is noticeably expensive, and we need to be realistic about the financials. This is not a company that is printing cash yet. If you look at the income statement without context, it looks ugly.
Let's hear it. Give me the good, the bad, and the ugly.
The good is the revenue growth. Trailing 12-month revenue is sitting at around 71 million US dollars. If we look at the most recent quarter, they brought in roughly 140 million Hong Kong dollars.
Okay, so money is coming in. It's not zero.
Yes, but the burn is real. In that same quarter, they posted a net loss of roughly 592 million Hong Kong dollars.
Ouch. So for every dollar they bring in, they're spending, what, 4?
Roughly, yes.
That sounds terrifying. Why shouldn't investors run for the hills?
Yeah, because you have to look at what they're spending on. They are building the factory, essentially, pouring money into R&D and manufacturing that fleet. The big question, the one every investor asks is, will they run out of money before they turn the corner? Is the runway long enough?
That's the billion-dollar question. How does the balance sheet look? Are they running on fumes?
Far from it. This is where the bull case really gets its legs. They have what I'd call a fortress balance sheet for a company of this size. Their current ratio is 8.39x.
8.29. Okay, for the non-accountants listening, break that down. What does that number actually signal?
It measures your ability to pay your short-term debts. A ratio of 1.0 means you have just enough cash to pay what you owe. A ratio of 8.39 it's almost unheard of. It means for every dollar of debt due soon, they have over $8 in cash or liquid assets.
So it's survival insurance.
Exactly. It implies robust liquidity. If the market crashes next month or there's a regulatory freeze, WeRide doesn't go bankrupt, they can keep the lights on. Remember, they just had their IPO in October 2024, where they raised nearly $440 million US.
That's a serious war chest.
It is. Analysts estimate this gives them a runway of about 2 to 3 years at their current burn rate.
That's a lifetime in the tech world.
It is. It gives them the breathing room to get that Abu Dhabi fleet profitable and expand the WeChat integration without constantly worrying about making payroll.
2 to 3 years is good, but it's not forever. When do analysts actually expect them to be fully profitable? Not just single vehicle profitable, but actually making money as a whole company.
The consensus projection is 2029.
2029. Okay, so we are looking at a 3-year waiting game, give or take.
Yes, it requires patience. This is not a get-rich-quick trade for next week, but the path is visible. It's not a vague hope anymore, it's a math problem. If they keep scaling the fleet and unit costs keep dropping, 2029 is a very realistic target.
And clearly, Wall Street seems to think so too. We touched on ARK, but what are other analysts saying? Is it just the high-risk tech funds, or are traditional banks on board?
It's broader than you might think. Citi analyst Jeff Chung recently issued a buy rating. He has a price target of $39.60 Hong Kong.
And the consensus?
The consensus target is around 39.37 Hong Kong dollars, so there's significant upside, and the overall rating is a strong buy.
That's reassuring. It's not just one rogue analyst shouting into the void.
No. And we ran a sentiment analysis on the recent headlines. About 80% of the coverage is bullish.
That's a very strong signal. Usually, with these high-growth stocks, especially ones burning cash, you get a lot of skepticism. They're burning too much, the tech isn't ready. But 80% positive suggests the market is starting to believe the execution story.
Right. And again, that ARK invest buy is a signal. Kathy Wood often talks about convergence. Here you have AI, robotics, and energy storage all coming together in one vehicle. It's a multi-decade growth trend.
Okay, I'm feeling the excitement. I can see why the stock popped, but my job is to be the paranoid one here. If this was a sure thing, the stock wouldn't be bouncing between $6 and $44. What can go wrong? What kills this thesis?
You are absolutely right to be paranoid. There are real risks, and they are significant. The first one is the obvious one, cash burn.
We mentioned the runway, but what if they don't hit that profitability target?
Exactly. If unit economics don't improve fast enough, let's say the tech hits a snag or maintenance is more expensive than they thought, that runway shrinks. If they get to 2028 and they're still burning cash like crazy, they will have to raise more money, and that means dilution.
Dilution is the enemy of the shareholder. They print more stock, and my slice of the pie gets smaller.
Precisely. So you have to watch those quarterly reports like a hawk. But there's another risk, maybe even bigger, the geopolitical angle.
The elephant in the room? They are a Chinese company with global ambitions. The relationship between the U.S. and China is, well, complicated, doesn't even begin to cover it.
Complicated is putting it politely. This is a significant risk. WeRide relies on support from the Chinese government and partnerships with state-linked entities like GAC Group.
Does that hurt them in the West?
It absolutely could.
Huh.
Tensions between Washington and Beijing could impact their ability to operate in Western markets. We've seen it with chips, data, social media. If the U.S. decides to clamp down on Chinese AV software due to data security concerns, that U.S. license they have could be revoked overnight.
That's a scary thought. A stroke of a pen could wipe out a huge chunk of their potential market.
It is. But remember, they are dual listed on the NASDAQ and in Hong Kong, which helps. And frankly, their pivot to the Gulf and Europe is a strategic hedge against exactly this scenario. If the U.S. market closes off, they still have the Middle East, Europe, and the massive domestic market in China. They aren't putting all their eggs in the American basket.
That's a smart move. It feels like they saw this coming and built the business model around it. So taking all of this into account, the licenses, the tech, the cash burn, the geopolitics, where do we land? What's the verdict?
If I had to give this a score, I'm landing on a bullish 7.5 out of 10.
7.5, that's pretty high for a pre-profit company.
It is, but here is the elevator pitch. WeRide is the first globally diversified AV company. They have the permits, they have the cash for now, and they have the WeChat advantage, which gives them an unfair advantage in getting customers cheaply.
So who is this for? Is this for the retiree looking for safe dividends?
Definitely not. Please do not put your rent money into this. This is a medium-high conviction play for growth portfolios. If you're building a portfolio for the next decade, this belongs in the innovation bucket. I'd say a 3 to 5% allocation is appropriate.
And timeline.
You need to hold this for 18 to 24 months, minimum. You are waiting for that Abu Dhabi profitability to hit the headlines and for the fleet to expand. You have to be willing to stomach the volatility in the meantime.
And for those listening who want to time their entry, is there a price point you're watching?
Given the volatility, buying on pullbacks is the tactical move. If you see it dip below $8, that has historically been a strong accumulation zone.
Okay, so sub $8 is the buy zone. Hold for 2 years, watch the burn rate, and keep an eye on the geopolitics.
Precisely.
This has been fascinating. It really feels like we are on the cusp of something real this time. It's not just flashy videos, it's balance sheets, government permits, and real fleets on real roads.
It is. And I want to leave you with one final thought to chew on. Everyone is obsessing over the U.S. market, what Waymo is doing, what Tesla is doing, but WeRide is proving that the path to autonomous profit might actually run through Abu Dhabi and Guangzhou first.
That's a really interesting perspective. We're so U.S.-centric, sometimes we miss the bigger picture.
Exactly. If WeRide hits unit profitability in the UAE before anyone makes a dime in San Francisco, the game changes overnight. Capital will flood to where the profit is, not just where the hype is. The winner of the AV race might not be the one with the best software, but the one with the best business model in the right geography.
That is a powerful thought to end on. The map is changing, and we need to look beyond our own backyard. Thank you for breaking this down.
My pleasure.
And thank you all for listening. If you enjoyed this analysis of WeRide, let us know in the comments. Are you bullish on robotaxis, or are you staying behind the wheel? We'll see you in the next episode.
See you tomorrow.